Lance World.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. It is, of course, the Hump Day edition of The Real Investment Show. I'm your host, Lance Roberts. Of course, Danny Ratliff will be joining us this morning to talk a little bit about financial planning and all that kind of other stuff that's going on now, particularly, in this market. Interesting, a lot of data out over the last few days. And a lot of talk about the employment number last Friday. Of course, that was this huge 2.5 million job surge in the economy, and the employment rate came in at 13.3%, and that's all that's been reported by the media, of course, over the last several days. Is like, the economy's roaring back and we're doing things. Well, we talked about the data collection problems in our newsletter this past weekend. So if you haven't read it, go by the website, realinvestmentadvice.com, just click on the newsletter link. And we actually talked about even the BLS, the Bureau of Labor Statistics. This is the organization that actually puts all the data together, admitted that there was collection problems. And this is the important thing, an ongoing error in the calculation of the data. And they're not sure why this error is in the data, but it's an ongoing error. Now, it's not just a one-time error. It's not this, we had this error last month because of the shutdown and all this. No, this is an ongoing calculation error. And if that, with that error adjusted, if they recalculated the data based on that error, then the unemployment rate for April was 5 percentage points higher in April and 3 percentage points higher in May. So in other words, instead of a 13.3% unemployment rate, well, it was a 16.3% unemployment rate. And if we actually add in the people that just fell out of the labor force because we decided not to count them anymore, we're closer to 17.1%, which was in line with estimates. So if we actually kind of recalculated the data based on the stuff that we know, the estimates for 17% unemployment was about the right number. Now, regardless of that, 13.3%, 17%, 19%, doesn't matter what the number is. Those are the highest levels of unemployment on record going all the way back to the Great Depression. Right after the stock market crash into the Great Depression, unemployment rates hit 25% in America. And what a lot of people don't understand about the Depression is there was actually a massive dust bowl in the middle of the Midwest that led to, farmers losing cattle. The government had to come in and buy cattle. People could not get jobs. They moved out to California. There was too many people living in California. They couldn't get jobs there. There were tent cities. There was a lot of other problems with the Depression outside of just the stock market crash. But unemployment rate, much smaller population back then as well, 25%. So on a comparative basis, 18% unemployment in the U.S., very comparable based on the size of the population to what we saw back in the Great Depression in terms of the economic impact. But here was the interesting note that came out this morning. This was in the Wall Street Journal. Because of the shutdown and because that the BLS did exactly the same thing as everybody else, right? They sent everybody home, had people working at home. The survey, so every month when they do this unemployment report, they reach out and they call 30,000 homes and they collect the data. The number of contacts that they actually made dropped massively, because people were working at home. They were working under the COVID rules of workspace environments, those type of things. So the number of people actually contacted for the survey had dropped markedly. So in other words, we really have no idea what the unemployment rate is in America today. We really have no idea. The data collection on all of this data is so skewed and so broken at this point, it's going to take months to actually figure this out. Now, when we look back at this in the course of the next couple of quarters, we'll look back at this data once we kind of get it all smoothed out and we get the real numbers. We'll go, that was clearly not the right number. So we'll figure it out. But here's the important point about this. Markets have been rallying sharply over the course of the last couple of months on expectations we're going to have this massive V-shaped recovery in the economy. And so we're basing a lot of it, a lot of our investing dollars on hopes that things are going to occur. Things like a very quick turnaround in terms of employment. We're going to put everybody back to work very quickly. So if you lost your job in January or February, you're back to work by June or July. that's a very big stretch depending on, how fast the actual economic recovery can happen. The second thing is assuming we actually will have no secondary wave of this virus. Now, we will not shut down the economy again. We've talked about this before. We won't shut down the economy again. We learned our lesson from that. But if there's a secondary wave, that is going to slow people getting back out, going out to stadiums and restaurants and places if they're concerned about their health. That would slow the recovery. We're already starting to see cases pop up across the United States. And in fact, the number of daily cases are starting to pick up here a little bit. Texas hospitalizations are back markedly on the rise. Of course, not surprising as we reopen businesses and people go back out. And of course, if you're spending some time in big crowds rioting and throwing bricks, you're probably going to get a virus. So, we're starting to see those cases come back up, and we'll see just what the impact of that's going to be. But the expectation of this rally is that there won't be a secondary wave. The third is that this rally is based on the idea we'll have a vaccine. And we've talked about the real risk of getting a vaccine anytime soon. Even today, we have therapeutics for the flu, which is much more contagious and really has a much bigger impact on an annual basis than what COVID did. We still don't have a vaccine for it. We do have therapeutics, but we don't have a vaccine for it. And so vaccines are very, very hard to come by. They take years to get to market and to develop and test. And while there's been a lot of this rally based on this idea that some company is in phase 1 trials, about 99.9% of these drugs that are in trial are never actually going to come to fruition. So the point here is markets are way, way ahead of the economic and market realities of what's happening. Corporate profits are declining sharply. Earnings are going to be down sharply over the course of the next couple of quarters. So the point that we're making here again is that while the market's been good and it's been good to participate here and make some advances in portfolios, but we are very, very extended here, so you're going to want to start looking for a pullback. One thing we talked about yesterday in particular was looking for a risk-off rotation trade, and that was in treasuries. And of course, we talked about this last Saturday in the newsletter as well. Treasury bonds have been extremely oversold here, and of course, yesterday had a nice little uptick in treasury rates as yields started to fall again. And falling yields as the economic kind of weakness continues is very likely. We're very likely to see yields come back down below 0.5% interest before we get to this. They just kicked up onto a buy signal here just recently. So again, this is kind of an area of that risk-off trade that is likely to play here for the next couple of weeks. Now, the big news today, and we're going to go into a lot of depth tomorrow on this, is the Federal Reserve meeting that comes out this afternoon. It's been a 2-day meeting. Jerome Powell will speak this afternoon right around 2 o'clock. And we'll kind of get his first take on the employment data, the economic recovery, where we are, and most importantly, what they're going to be doing or planning for their stimulus programs. Is there more stimulus in the pipeline? That's going to be the big question that the markets want to know, and that's going to have a big impact on potentially where the markets go here, and particularly where Treasury yields go over the course of the next couple of weeks. And this is, one thing that everybody's going to be paying attention to the Federal Reserve is talking about yield curve control. In other words, will the Federal Reserve limit the height at which rates can rise? So in other words, will they start capping rates at 1 or 1.25% because rising interest rates in an economy slows economic growth? When you're financing cars for individuals for 84 months just so they can afford the payment, they cannot afford a rise in interest rates. So yield curve control in some kind of camouflage text is going to be really what everybody's looking for, particularly in the bond market. But we're going to talk a lot about this tomorrow with Michael Leibowitz here on the show. So once we get the notes out from the Fed meeting today, definitely tune in tomorrow and we'll go through those in detail. Okay, quick break. Get by the website, realinvestmentadvice.com. Our latest blog post is up called The Fed's Monetary Animal House. That's on the website now from Michael Leibowitz talking about Fed policy. And we'll come back after the break with Danny Ratliff. So don't go away. You're listening to The Real Investment Show. I'm your host, Lance Roberts.
Romeo and Juliet are together in eternity. Romeo and Juliet.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
A modern day warrior, mean stride. Today's Tom Sawyer, mean ride.
And welcome back to the show this morning. I'm your host, Lance Roberts. Danny Ratliff joining me this morning. Good morning, sir. How are you?
I'm doing great. How about you?
I'm doing well. A few stories to kind of get into this morning that we want to talk about. One is it's interesting because a lot of this rallies, and I was talking about this just a second ago, that a lot of this rally has been based on this idea that there won't be a second wave, and of course, as we go to reopen cities and people go back to work, etc. And of course, if you're out rioting and talking and being in large crowds, there's a risk that you're going to potentially catch an infection. Texas hospitalizations hit 2,056, which is a record high. And more than half of U.S. states now see cases of COVID back on the rise. So it's just something worth paying attention to because New Jersey just decided to abruptly kind of reopen their state. And of course, this was one of the hardest hits, and they've been really locked down. They've seen a dip in cases, so now they've decided to reopen. And when you live in smaller states like New York and New Jersey, you've got just a much more condensed population. So it's very likely, here in Texas, we all are all spread out. You have to drive an hour to get one place to another,
and you have no mass transit of any.
Exactly. So there's just this cluster. So potentially you're going to see this secondary rise in cases. So it's just something as we talk about this and watch this. And there was an interesting study out yesterday as well. The data that comes out. Yesterday we had the job opening labor turnover survey. Now, this is a survey that talks about how many job openings there are. So, do we have a job opening here at our office? And if we answer the survey, yes, we have 2 job openings at our office. Well, that's marked down as a job opening. And then they ask the question is like, do you have anybody to fill it? No, nobody to fill it, right? We can't find qualified personnel or whatever the answers are. But we have an opening that's not filled for one reason or the other. It was interesting because we just saw 2.5 million people hired back. Where were those people hired back, right? It was in leisure, hospitality, construction, retail, trade. Exactly what you think, right? If you're going to reopen your restaurant, your retail store, got to hire some people back, got to have some people there to actually work the door. So surprisingly, you would see people coming back. That's not really a surprise. Here was the interesting story from the job opening survey yesterday is that the number of job openings have stalled. So in other words, I had job openings when I was shut down. I've now filled those, and I don't have any more job openings. So this is going to be kind of an interesting thing. Next month, we may very well see the rate of hiring slow dramatically, right? We just had this initial surge of putting people back to work. Next month, everybody kind of status quo type thing. So we'll see. But this is what I'm talking about with a lot of this economic data. There's a lot of faults with a lot of this economic data, because things are so skewed. We have never seen some of these levels before in history in terms of the numbers of unemployed, the numbers of jobless claims. I mean, you're talking 2 million people a week on jobless claims, new jobless claims, right? This 2 million people just, got laid off last week filing for a jobless claim. So, those are the things we're seeing, and those are never before seen levels, and they've completely skewed the data. So it's going to take a while for all of this to kind of work itself out, for us to kind of really understand what the impacts are. But one thing I wanted to get into, and I wanted to hit Danny with this on a surprise basis this morning.
Oh, great.
It never ceases to amaze me that the government goes along with Wall Street in terms of figuring out new ways to extract capital from the people who can afford to lose it the least, right? And that's your mom and pop retail investor.
Main Street.
We've talked about the problems with pension funds. And, this has been one of the kind of ongoing problems. We've written several articles about this. I just wrote one recently talking about how the pension crisis has now arrived. And that's here. And I wrote about this maybe a month and a half ago now. It's time flies when you're having fun. A new article out today. Alarming study finds that U.S. public pensions will run out of money by 2028. And this is exactly what we warned about. We actually warned about the coming pension crisis about 3 years ago. And we said, look, when the next bear market hits, these pensions are already massively underfunded. Their return rates at 7 or 8% are way too high. And they can't make those return rates. And so as they have more and more people leaving to start drawing their pensions, their returns, they're not meeting their returns. And the reason the return, and people go, well, let's lower the return rate. You can't. Because if they lower the return rate from 7% to 6%, I've got to go to Danny, who is one of my union workers, and tell Danny, I need you to contribute 10% more to your pension. He can't. He's living paycheck to paycheck already. And he's already making his pension contributions. So the pensions are trapped in having these high rates of return because they can't go to the pensionees and say, contribute more money. Every percentage decline in the return rate is a 10% contribution increase by the employee. So the math doesn't work. It hasn't worked for decades. It's not working now. And the bigger problem is that young people aren't having kids. They're not joining unions. So the number of people that are contributing to these plans are being reduced by all the baby boomers now drawing out of it and moving in. So this has become a bigger problem. And my warning back 3 years ago was when you have a bear market, you already have this hole in pension funds. You're just going to make that hole massively bigger. And that's exactly what's happened. Now the new study that's just come out confirms what we said 3 years ago. You're going to have a problem here. Pension funds are on the verge of running out of capital. It's going to require another government bailout of about $6 to $7 trillion to fix those pension funds. Now, we'll see if that happens. But here's the other problem. So companies decided a long time ago, it's like, you know what? We've been nice. We provided Danny this nice, healthy pension. And there's a lot of people that have pensions from private corporations. They do great, right? But, we really don't want that liability because it detracts from our profit margin. We have to contribute to that pension plan too. So if I've got to put money into a pension plan, well, that just detracts from the money that I can put in my pocket as a corporate CEO or do other things with, like buy my shares of stock back to improve my earnings to boost my bottom line profitability. So my share prices are higher that I can sell. So if I don't have to fund that pension, that's better for me as the company on a greed basis, right? So what they did was they came up with this idea of a 401k plan. It's like, hey, let's shove all the retirement capability off onto the individual. So now Danny's responsible for his own retirement plan. He's living paycheck to paycheck because wages aren't rising. The rich executives are getting richer because of their stock option programs that they're manipulating behind the scenes through share buybacks. And Danny's sitting there going, man, I don't understand why this isn't working, right? And then there's the bear market in 2001. There's the bear market in 2008. They're just told to buy and hold, write it up and down. They keep losing tons of money. So finally, they just give up and say, you know what? Screw it. I'm not going to do it. So this is why the average 401k, only 1/4 of Americans actually contribute to a 401k plan. The average balance is about $50,000, $60,000. That's about 1 year's worth of savings in retirement. So why am I bringing all this up? Because like I said, Wall Street's always trying to figure out a better way to extract capital from you. And here's the new one. 401k plans can now invest in private equity funds. The Department of Labor says retirement plans can now include alternative investments.
Now, this is about the dumbest thing I've ever heard.
And for two reasons. One, alt funds have extremely high fee ratios, generally 2.5%, 3%, and then or there's some type of participation rate in there between a fee that you pay of say 2%, a 20% back end on gains, whatever it is. But alt funds historically underperform almost all other investments out there over long periods of time. But private equity funds need access to capital. And what a great way to get access to capital than to tap into 401k plans. And people that don't have any idea what they're actually investing in.
Well, this may be right for a sliver of the population. Most people have no idea how to even do the homework on what these funds look like and how to actually invest and what they invest in, because many times it's all going to be covered under a veil. And so this is really bad for Main Street, because typically, when big firms or Wall Street has trouble, what do? They put together some sophisticated product, tell you how sexy it is, and say, hey, come buy it now. Mm-hmm. And unfortunately, who gets burned? Do you think Wall Street gets hurt from this? Absolutely not.
No, they got your capital.
Yeah, that's exactly right. So this is a really unfortunate situation. I think that 401ks have enough trouble. I'm hearing daily that, people are not receiving matches anymore. And then we're going to throw these other things in here because now we didn't get those promised returns of what we've always expected. And you've got to turn around. And now you're going to say, well, maybe I need to go do this. Something needs to change. I'm going to do something different. And this is where people get burned.
Absolutely. All right, quick break. We'll come back. Don't go away.
I'm swinging at the voice in tune and I'm feet flying up in the air. Singing, hey, titty, titty, with a kitty in the middle and I'm swinging like you just don't care.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Welcome back to the show this morning. I'm your host, Lance Roberts. You know, we've talked about on the show. I'm gonna deviate real quick, and I'm gonna jump back over to Danny. He's got some other topics. It's just an interesting study out this morning. We've talked a lot about in the last really 30 years since the Department of Education was formed in the government, and we took control of education out of the states. The education level in the United States, we dropped out of the top 5 in terms of math, science, language. We've dropped out of that. We were in the top 2, 3, 4 ranks in education prior to 1980. Once the Department of Education took over control, we now rank somewhere in the 27th level for math. Science is way down there. I mean, countries like Ethiopia are better off in terms, and Estonia have better ratings than we do in a lot of cases. But it's interesting now because of the COVID, right? We've had a very, very sharp decline in public sector employment, K through 12 education levels in terms of teachers, right? We've just, a lot of teachers have been laid off, and we're talking about now, my kids are talking about next year's school. They may go to school 2 days a week, alternating kids, and they're going to do a lot of their learning online because of this whole virus thing, which means that we need less teachers back, which I'm still asking the question, and I haven't got a response from anybody yet, is that if I'm paying for less teachers and less school time, then I want my school taxes to go down. I want a refund. But it's an interesting conundrum because we need a correlation. So we have this big decline in the number of educators for our K through 12. So we've got more kids coming in to society every day, right, through birth rates. Even though we have a very low birth rate, lowest birth rate since the 1940s, we have more kids coming in and getting into the school system. But yet we have this big decline now in the number of educators available to teach them, right? So this is going to be problematic. But I think we really need now to have a correlation between this graph of this decline in educators and the number of parents who are now homeschoolers and alcoholics. So we'll see how this works out. But, apparently drinking at 10 a.m. is now a thing. So,
Man, if I was at home with my 3 trying to teach them, we'd have a problem.
Danny'd be calling up. I can't come into work today. I've got 2 kids in detention.
Oh, they would live there. That's for sure.
Anyway, so I'm sorry, just some little bit of humor for you this morning. Okay, let's get into. So just for the break, we were talking about 401k plans and now just another tool for Wall Street to get in to extract more capital from investors. And again, these things never work out well. I mean, and we were talking about pension funds. Pension like Dallas made bad investments into real estate. It happens even to the professionals. So if highly educated, sophisticated investors make bad investments into public investments, what's the risk to individuals. And this was, and the big thing about this is that normally to invest in these things, there used to be criteria. You had to qualify to invest. You had to have like $1 million worth of net worth or $250,000 a year in income.
And to be an accredited investor.
And to qualify as an accredited investor. And the belief for that is that you were smart enough. If you made that much money, right, you're smart enough to know what you're doing. And then you had to sign a long document that basically says, I am an accredited investor. I understand the risk. I understand I can lose all my money. It's all on you. So again, Wall Street lobbied government over the, during the, decade-long bull run that we had with lots of Fed support and stimulus, and got these rules changed to start allowing individual investors to invest in these highly risky products. And this is not going to work out well. These things never do. They may work out for a while, But as soon as you eventually get a real bear market, and again, we haven't had a bear market. Let me just be correct. I've been writing about this for the last several weeks. The decline in March was not a bear market. Yes, it was more than 20%. But because we were so extremely deviated above the long-term trend line, that the 35% correction only brought us back to the long-term bullish trend line. It was a correction, not a bear market. A bear market is when we change directional trend and prices and we go from an advancing market to a declining market. We had a correction. That's all we had. When we get into a bear market, which is likely going to be much more frequent going forward because of the debts and the deficits and the things that we're doing monetarily to our economy, these investments won't work well. So,
well, I could go a lot of different ways with this because this is a vicious cycle. And so you and I were talking about something after the break that, a lot of financial advisors, there's an article out saying that they're losing faith in financial planning software. And I think this ties in very well to kind of the pension crisis, where people start to get into holes where they do things they typically shouldn't do. And so a lot of advisors are losing faith because they come out, they take these things out of the box, which we've talked about frequently, and then they turn around and expect all these numbers just to be accurate because that's what comes out of the box. And so we've talked frequently where, Lance, you're adjusting capital market assumptions within the plan on an annualized basis. We're changing things based on PE ratios, a number of different fundamental factors, and where I don't think many people do that. So same thing with pensions. Pensions get in here, and they're essentially interviewing money managers saying, okay, Lance, what are you going to get for me? Oh, wait, nope, that's not enough. Let me go to the next guy. So they're going to go with the guy who's going to promise them the most, and they're going to put this in their plan. And unfortunately, when we look at these financial plans, we do something similar. And then what will end up happening is that we'll do something like Dallas. So Dallas had a great plan years and years ago as far as the pension goes. And then they had to go out and go buy all this risky real estate just to make up for the returns they did not get. And then it put them in an even deeper hole. And that's unfortunately what I feel like is likely going to happen here, Lance, when you talk about allowing private equity into 401k plans that it typically has no business being in. And so, there's a fiduciary standard associated with a lot of these 401ks. And this is going to be really interesting to see how people broach this topic and actually bring these things up. Because as somebody who oversees 401k plans, I would have a very, very difficult time putting a product like that inside of a plan.
Sure.
I mean, how can you explain that? The average investor, I think that most people listening to the show are very, they're fluent. They understand what goes on in markets. They're probably have a little bit higher investing IQ than most. But when I'm talking to 401k plans, this is a different story. And I think that the average person out there has a lack of knowledge because of, one, I think it's a paralysis by analysis, so much information. And two, we're misled by the financial media so often to sell a product, which is going to be exactly what happens here.
Right. And again, and back to the financial plans, a plan is a plan is only as good as the information you put into it. It's the old issue of garbage in, garbage out. Kind of like our BLS employment report last Friday. We're talking about this morning. No, the collection rate of the data dropped sharply, so you had a much smaller sample size to base that employment report on. So, it's garbage in, garbage out, right? And so as these things kind of work themselves out, we'll find out what the true story is. Well, this is what happens with plans, which is they don't take into account things like, high valuations or where interest rate levels are, the trend of interest rates. These all have impacts on future returns of markets. So if you build a plan today and say, oh, I'm going to use 7% because I like that number, it has no real context into what's really happening within markets. And then what happens for most people is they build this plan and they stick it up on a shelf and they never look at it again. Well, my plan said I had a 99% chance of success last year. So I'm good. I just keep doing what I'm doing. I'm all fine. Well, you don't get 7% the next year. You don't get 7%. Then you have a bear market, and then maybe you have a few good years, but then you have another decline, and you never look back at your plan. And what you'll find out is it's the old idea of that if I drop a rock off a cliff and a bird hits the rock and moves it by just 1 inch, by the time it gets to the bottom, the distance from where the original target was is far off the mark. And that's what happens. Small misses in your plan early on lead to big misses in your plan when you actually get to retirement. This is why any plan It's whether it's a business plan for running your business or whether it's your financial plan for running your money, whatever it is, you have to review these things every single year and sit down and readjust what worked last year, what didn't work last year. Do I need to adjust my plan to make sure I'm at goal? We had this event that wasn't in the plan. This COVID-19 thing, that wasn't in my plan. I need to come and revisit my plan and redo it. And that's why we review our plans every single year. This is why we benchmark against the plan. And this is why we focus our risk return structures on what these plans are dictating so that we can adjust for these events, but have the most realistic opportunity to reach those goals. And this is the thing that, it's understandable. People are losing faith in their plans because they've not worked because they haven't been planned properly.
Well, that's right. And you get out of these what you put in. This is one of those deals where you have to spend the time. And so don't put it on a shelf. Go out, talk to your advisor, make sure that you're in the right place. Have you actually gone and reviewed your withdrawal strategy? That's something I think that many people just say, oh, it's set it and forget it, 4% rule. Unfortunately, it needs to be dynamic in this day and age. So make sure that you're addressing those issues with your advisor. If you're having trouble, you don't have somebody to talk to, don't hesitate to go to realinvestmentadvice.com, go to ask a question. We would love to help.
That's right. We'll be right back. We're going to talk a little bit about investors go crazy with bankrupt companies. Don't worry, we'll be right back.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
And welcome back to the show. I'm your host, Lance Roberts. Danny Ratliff joining me this morning as well. I remember back in, it's got to be now, probably 2006, 7, somewhere around there. I can't remember exactly when Kmart originally filed for bankruptcy. It's, decades ago. This was when Kmart was an actual store and you would actually go around and go to a Kmart. Anyway, they filed for bankruptcy, and this is before it was taken over by Sears Holdings and, that whole thing. But at the time, when they filed for bankruptcy, all these young investors ran into it and started buying the company stock. And the thought is that, when they came out of bankruptcy, right, they wouldn't have any debt and the stock would just soar. Well, the problem is that when companies normally, I want to clarify, I want to make sure I quantify this. Normally, when a company goes through bankruptcy, two things happen. They go in front of a bankruptcy judge and they say, Judge, I have all this debt. The purpose, and this is the problem that we've had over the last few years, is not allowing the bankruptcy process to occur. Bankruptcy doesn't mean that Kmart was going out of business and would cease to exist, right? Them filing bankruptcy didn't mean that tomorrow you're going to wake up and there's going to be strip centers all across the country with empty Kmart stores. That's not what bankruptcy means. Bankruptcy, they go in front of a bankruptcy judge and say, Judge, I got too much debt. I can't pay my interest payments. I need to restructure my company. I'm going to file for bankruptcy. I'm basically going to default on my debt. And, I'm going to come up with a payment plan for my debt coming out of this. Judge approves it, and then they work it out. CIT did this during the financial crisis. I bought a bunch of CIT bonds back during the financial crisis, got converted to equity coming out of the crisis, made a bunch of money with them, right? So the problem is that when companies come out of bankruptcy, the shareholders get wiped out, right? That class of stock goes away. It is worth zero. And all these people were buying Kmart stocks thinking they were going to make all this money coming out of bankruptcy, and they wound up losing it all because that stock went away. The bondholders generally get some type of payment. So, let's say I've got $1 billion worth of debt. I've got $400 million in the bank in cash. So I give all my bondholders, 20 cents on the dollar, and then I give them a bunch of stock in the new company structure coming out. So hopefully they've got an opportunity to make some money back as the company recovers. And that's what CIT did. They issued some new bonds and they issued equity, and that all worked out well. Now, that didn't necessarily happen during the financial crisis. We bailed out GM and we did some funky things with the GM bankruptcy that wasn't normal. But in normal cases, equity holders get wiped out. So why am I telling you all this? Well, there's an article out in the Wall Street Journal today talking about individual investors are basically have forgotten all about risk. They're piling back into margin debt, right? They're leveraging up their bets in their portfolios by using debt and leverage. And they're using the debt and leverage to buy Hertz. Now, Hertz is a bankrupt rental company. They have already filed bankruptcy in May, right? The stock is up 800% since their lows. So all these investors are chasing, Hertz rental company, thinking they're going to come out of bankruptcy and be fine. And the bonds tell the real story. Hertz bonds are trading at about a nickel, right? So if you had $100 in a Hertz bond, they are currently telling you your bond is worth, your debt, your loan is worth about a nickel. And that's the real value of the company, what's in the debt. So likely what's going to happen with the bankruptcy is they're going to come out of bankruptcy. Hertz isn't going away. Hertz rental car is not going away. If you're a Hertz club member, your card's still good, right? They're not going away. When they come out of bankruptcy, they're probably going to convert a lot of their debt into equity. The equity that currently exists is going to go away. So if you're long Hertz stock right now, it's going to go to zero at some point. That's if. Now this is what I want to quantify, right? Nothing happens normal anymore in terms of bankruptcies and the things that we do. We're bailing out companies that we shouldn't. Normally, if the bankruptcy process occurs normally, that stock will be worth zero. But there's always the opportunity that something else may happen. But the real point here, though, is that in young investors, in particular millennials, this is happening a lot on Robinhood, et cetera. They're buying companies like Hertz, which is bankrupt, Luke & Coffee, which has already been, they've already got massive accounting fraud and scandals, but they're buying that stock thinking that, it's going to be good. That's not investing. That's just purely speculating and gambling. And typically doesn't work out well. But the use of leverage is what really blows the whole thing up. When you lever up in a portfolio, you can be forced to sell. So if Hertz falls, if you're levered and you're buying Hertz and Hertz stock price falls, from $5 back to $2, you're going to get a call from your brokerage firm saying, you need to cover that balance of that margin loan. And you will be forced, if you don't sell it, we're going to sell it for you. And you'll be forced to sell and close out your account.
Well, that may be happening right now because it's down 25% yesterday, down 10% today already. Yeah. These are things that you can see.
And by the way, fun with math, 1,000% up, right? That's great. $1 to $10, that's 1,000% up. 25% down takes you from 10 to 750. So math in reverse, 1,000% gain is wiped out by 100% loss. Just keep that in mind. Fun with math.
Yeah, it's funny when you put it in those types of those parameters. That context certainly it changes the view of it a little bit, right?
Yeah,
because everybody goes, make 1,000, you lose. Wait, okay, hold on.
Exactly.
But it's interesting. There's still this big disconnect between Main Street and Wall Street, and so part of this is looking at this rally. If you look at the Wilshire 5,000, only 3,470 companies haven't made a penny this year. Wait a second, did I say that right? Yeah. Only 3,470 companies have not made any money. So your
out of 5,000.
Yeah, out of 5,000. So no, I was doing that for emphasis, by the way.
Gotcha.
But so you think about that, then you look at what Wall Street is doing and professional investors who have billions and billions of dollars at their disposal for research and what Main Street is doing. So, and I think that some of this ties back to what we've talked about all day is that people get in holes, they start doing things that they're typically not they typically would not do, but you feel like you have to do something. You have to get some returns. So if I'm in Hertz, I'm not making a recommendation here, but I wouldn't have been in it in the first place. I'd be getting out. That kind of stuff would scare me to death unless it's a trade, right? And that's the tough part because you have so much speculation, which is driving the broader market. And, we're hearing from people all over. They're saying, hey, returns. We're getting a lot of calls from client or people at other firms saying, my returns aren't very good. What's going on here? And I think this is across the board that we're seeing, if you're not taking that additional risk in these speculative companies, you're not going to have that big reach of a return that you would typically expect. And that's what the disconnect is with the market between Main Street and Wall Street. It's kind of interesting when you put it in, when you think about it, all that's going on right now. and where we are likely to go. So who's right? I mean, I hope it's Main Street. Hopefully everything opens up and everybody's great. But man, there's still a lot of headwinds out there.
Yeah. Well, look, and if you take a look at a lot of the rally, so far in the markets, it's been, particularly over the last couple of weeks, it's been the companies with the absolutely worst balance sheets and the ones that are potentially most affected financially from an economic shutdown. Base materials, industrials, those are very economically sensitive, and their impact, the impact of their earnings has been devastating from this whole shutdown. But those are the ones that people are chasing now, just on the hope that everything's going to return back to normal. And the problem is at some point you've actually got to start understanding what you're paying for. And this is why we continue, and we talked about in yesterday's Technically Speaking post, is it's time to make a more defensive move and to start moving away from those companies back into stocks. And we made this change on Monday. We bought companies like Apple, Microsoft, Netflix. The reason we bought those companies is because they're highly liquid. It's easy in, easy out, right? So it's the first place that investors go to, big institutions go to, because if you're trying to buy, a few million shares of this or a few million shares of that, you can't do that in a lot of these companies because they're very illiquid right now. There's not a lot of volume that's trading in these companies, and so trying to get out of these, you get stuck trying to get out. So big hedge funds, they hide in places like Apple, Microsoft, Netflix that have lots of volume, lots of liquidity, easy to trade, easy to move in and out of without moving the price. And so we talked about that on Monday, and yesterday we actually saw that rotation. Apple, Microsoft, Netflix were up big, yes, 3%, each yesterday. Big move there. Big move in Treasury bonds yesterday. Treasury bonds were up about 2% yesterday, 1.5–2% yesterday. Same reason, right? Risk off, moving back into safety plays, and if we get a correction in the market, which we will, and again, let's not confuse correction with a crash. If a correction is simply 2, 3, 4, 5%, just not going up, you're actually going down a little bit. We will get a correction in the market to some degree, and money is going to flow into these more defensive areas for a risk-off trade. So that's why we were talking about that in yesterday's newsletter. It's on the website now. It's our Technically Speaking post, which is called Time to Make a Defensive Move. That's on the website. But that's exactly why we were making those changes yesterday, or Monday, actually. So what else you got, Danny?
That's it. See you later.
You're not going to talk about your candid coffee this weekend?
Yeah, of course we are, on Saturday. So,
yeah, he forgot.
It was going to be 30 seconds long? I've got 30 seconds. Perfect. That's all I need. No, so Rich and I, we've had a lot of questions that typically always come in. And so a lot right now surrounding, people who are unemployed, you've received a paycheck cut. How do you recreate that paycheck? What do you do? Anywhere from finding new jobs to making sure you're protecting and growing wealth in this time. I think we're in very interesting times at this moment. So we want to be open to talk about this. And so we are taking questions. Go to realinvestmentadvice.com. Go to ask a question. We're going to have some answers ready for you. Rich and I are going to be live. But we do want your questions ahead of time. That way, we can make the best use of our time together. So go check it out, realinvestmentadvice.com. Ask a question. You can sign up for registration. It'll be 9 a.m. this Saturday. We'd love to have you guys there. But, a lot to talk about. Exactly. The banner is on the website. So when you go to the website, you'll see a banner right on the front page. Just click the banner to register for the event. Again, it's this coming Saturday, 8 to 9 a.m. this Saturday. And simply, like I said, go to the website, realinvestmentadvice.com, click on the banner. And if you have any questions at all, like Danny said, hit the question button, and we're more than happy to answer those questions for you. Have a great day. We'll see you next time on the next edition of the Real Investment Show. Michael Liebowitz joining us tomorrow to talk about the Fed meeting today and what they say. But stick around, though, because Chris Salcedo is coming right up.
It's a rich man's world. It's a rich man's world.